Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your new host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today, we have a very special guest. His name is Jeremy Hill. He is the founder of JB Capital in 2023. He's raised and advised on approximately $1.5 billion in capital for growth companies across the industry spectrum, also well known real estate investor. Jeremy, welcome to the show.
Thank you, my man. I appreciate it. Nice to see you.
Nice to see you as well. It was good to meet you in person a couple weeks ago. So, yeah, let's get started. Go a little bit into your background and the types of funds you started and how you help people.
Long story, right? So we either need copious amounts of coffee or a glass of whiskey or some good music and some fellowship. But let me say, I started a company called JB Capital almost 25 years ago, kind of by accident. And the business started originally as an independent investment bank and advisor, which means we were a hired gun to go solve problems. And most of those problems had something to do with money, right? Weston's business or John's business, whether you're a software business or construction business or otherwise, there was people that were always looking for uh, differentiated capital. Capital different than came from your bank or your rich uncle or some rich schmuck at the golf club, right? You needed differentiated capital to solve problems, and we got really good at solving those problems. And over this last, almost 4 years, we've done a little bit better than $2 billion in advisory and capital work, have started 3 funds of our own, which was investing off of my personal balance sheet and then raising funds alongside that, and have I guess, learned a lot, made a fair amount of money, and made some great connections, and I feel like hopefully had a pretty good impact along the way.
Sure. Yeah, and you started a pretty large private credit fund. So, can you speak about that?
Yeah, I mean, so ultimately at the end of 19, made the realization or decision rather, anyways, it is that we were going to make the election to move out of the middle and to begin to do from a principal position what historically we had been doing off of the balance sheets of other banks, lenders, investors, old rich guys, right? So we had gone from advisor, banker, broker, putter, togetherer, right? If that's a word, right? To doing from a principal position. And so we started that um, and kind of worked our way through decision making. Learned a lot in the process, but over a couple of years, we made uh, 9 investments in that first fund. Ran into situations to where it is that we hit the investor maximum that the SEC has for private funds. Like I didn't know that was a thing at the time, right? So I'm
Hmm.
smarter today than I was yesterday, and hopefully tomorrow I'm going to be even smarter and more better and better looking too. I hope, right? But raised our first private credit fund. Started at the end of 19, first of 20. Made 9 investments through that fund. Lion's share of those have paid back. We have a couple of hanger honors. It is that we are still trying to move out the other end of the pendulum there. Um, that started our second corporate credit fund about 2.5 years ago, and our first real estate fund about 2.5 years ago. All of those funds at this period of time are fully capitalized and matured. And now we're kind of, those loans are just going through their maturity and payoff. And so we're
Got it.
looking at our next couple of strategies here over the next, quarter to what it is that we're going to release next.
Hmm. Yeah, so talk a little bit about the corporate credit fund and the real
Mhm.
estate fund. What exactly you lend to? Because it's private credit and it's a higher in the capital stack than common equity, which reduces risk automatically.
Good.
But how do you reduce risk and reduce the failure rate for those loans?
Yeah. So one of the very first interviews it is that we did, I remember the topic coming away is everything looks easy from the outside. Right. And so everybody it is that is either in the fund business, looking to get in the fund business, wanting to raise a fund, wanting to get in private equity, private credit, you take your pick. They want to be a real estate investor. They want to do all these kinds of things. Everything looks easy from the outside. And so the thesis on our first credit fund, and so you're right, it was private credit and primarily focused on corporate credit. So for us, the thesis was there was this growing group of companies across the country that were past the friends and family, mom and dad, rich uncle round of raising capital. but they really weren't yet to a point to where institutional capital, large, sources of capital could actually afford to pay attention to Weston and Jeremy's software business or construction business, right? We didn't need to borrow 50 or 80 or 100 or $200 million like you see in every headline, right? We needed to borrow 5 or 6 or 7 or 8, which was a weird check because it's a $5 million is a ton of dough for the local rich guy in Arizona or Florida or Texas to do all by himself. And anybody with any real money doesn't give a shit about a $5 million deal. And so you found it is that there was I think it was 200,000 companies in the country that are in this kind of $10 million in revenue to $100 million in revenue that are underbanked and underfinanced that needed to solve that problem. And so our thesis is let's go lend there. Let's go find value there. And we did. And we found an overwhelming demand for capital. We had a deficit to demand for capital, which sounds like a first-class problem, but it's still a problem, right? You had more borrowers that were qualified. We were finding that faster than we were raising capital. Again, first-class problem, but still. You're right. So one of the questions that you asked is where it is that we were kind of in the stack and how we were structuring these things. And
Yes.
so we looked at everything as it was definitely structured capital. So alternative capital or private capital, you want to think of as basically anything that's non-traditional or non-bank capital. The minute I leave traditional banking and move towards non-traditional banking, I'm looking at that as private or alternative capital. So all of our deals were structured. About 80% of our portfolio was senior, but we did have a couple of positions in there it is that were either mezz or pref. And so mezz or pref, think of that like the second mortgage on your house, right? It's not in first position, it's not the equity that you put in, it's that secondary position. And for such, because you were taking a little bit higher risk in the cap stack, it is that there's a risk premium for that we would charge more interest or have more oversight or do something according to the risk premium that is that we were taking. That was our corporate strategy, and candidly, we're overwhelmed with demand. It was a good problem to have, but
Yeah, definitely a good problem to have. So you raised from individuals. I know you did that previously, but now you're looking for larger check sizes, right? So
yeah, a
tell
little
us about the
bit.
capital raising process and what investors can expect.
What investors can expect or
Like
capital
what, yeah, what
raising?
kind of returns can they expect from these funds?
Well, so for our funds, we were targeting, mid to high digit, returns, right? I mean, we're targeting that kind of 13 to 20% type returns, right? And so that would come as a combination of kind of current pay, dividend paying monthly income, Scooby Snacks, mailbox type money. But then we were also getting either warrant coverage or profit participation or an exit fee or some other type of whipped cream capital above and beyond our current dividend it is that would track us towards that kind of high teens returns that we were targeting. That's where we were, right? You can't go out and publicly, wave that sandwich board and flag saying, give me all your money and here's going to be your returns. But that was what it is that our intention, indication, and practice was to move towards that type of return. Again, everything looks easy from the outside. And so we had several of our investments that were low to mid 20 returns, and we had a few it is that did not work out the way it is that we had expected. And so raising capital, doing deals, doing private equity and private credit is certainly not for the faint of heart.
Yeah, for sure. And we're seeing that quickly, especially with people that bought, assets with common equity in 2021. They've gone down, 20, 30%, wipes out some or all of their equity, which
Yep.
is kind of crazy. So, yeah,
Yeah, and
what are the fund? Yeah, you can go into that if you like, but what are the fund terms? Do investors get paid quarterly? How long is the fund, and what are the details there?
yeah. So, I mean, first and foremost, we're not soliciting, right? Like this is not a pitch for our funds,
Sure.
right? So the funds it is that we have at this period of time, we're not out actively marketing. So we've got 3 funds in the market that are done. They're fully capitalized, seasoned, and done. So we're not taking in any new investments. I'm not taking in any new investors for our funds currently. And so we're managing the assets it is that we have. We're doing 2 or 3 direct deals now to where it is that we see value. And we're either syndicating those, leading those personally. It is to where I'll be the first check in these funds, and then we're raising funds alongside that. We will launch 2 new funds probably the end of Q2. This year, that will be more kind of niche and specialized, um, more thematic in what it is that those are. And so when that time comes, we'd be certainly happy and excited to share those with you.
Sure. Yeah, and when you do raise those funds, what is your main way of getting investors? And like, what strategies have you seen the most success with getting in touch with partners, that might, invest larger check sizes or individual investors?
Yeah, the reality is that for everybody in your audience that's listening, right? This is the Capital Raiser show. Raising capital is fucking hard, and it's not getting easier. And so, my wife and anybody it is that's married, it is that's listening to this, is that your wife will tell you it is you never understand pain until you go through childbirth. I Raising capital is pretty close, sweetheart, right? Like I don't want to argue with any women that are listening, but um, this is tough and it's getting infinitely more competitive. And you are seeing the larger folks, it is the BlackRock and State Street and Vanguard and the big guys, this kind of 8 or 10 people move to a consolidation standpoint. They have more money, more influence, more gravity to what it is that they do. And candidly, everybody that's listening, they can outspend you and outmarket you. And so for me, for you, for anybody that is that's listening, it is that's actively raising capital, you've got to find a way it is to tell your story that becomes the differentiator, right? Like there's riches in the niches, right? So if there is a niche of what it is that you do or how it is that you tell your story or who it is that you are or the difference it is that you're making by way of your capital coming in and investing in Weston software business, construction project, apartment building, whatever the deal is, there's got to be some storytelling that comes there. Because if this is purely a mass market approach, you're going to lose because everybody else has more money than you. And so
Sure.
for us, the things it is that we have found great favor in is number one is relationships. We've been doing this a long time, right? Like ultimately, if I got out of the business of finance and deals and money management and investments and I opened a sandwich shop, I'm pretty sure most of the people that I did business with would probably come buy their sandwiches from me, right? And so a lot of what it is that you're doing is in that relationship side of things. Um, Raising money right now, the things it is that you got to look at too is everybody is looking at, well, why, liquidity premiums, right? Or illiquidity premiums is that, if I want to get into things and there's some uncertainty in the market, how do I get my money back? How do I push a button and go to liquid? And if I can't do that, what's the risks and the trade-offs it is for me being illiquid for 2 years or 3 years or 5 years or otherwise? Because if I think about myself, you think about yourself, anybody thinks about themselves, it is, where were you 5 years ago? Right? When you look at some of these funds, it is that have a 5 or 7 year lockup with, additional, kind of 1 year extensions on top of that. The difference is me as an individual, my balance sheet and my money 5 years ago versus today or today versus 5 years from now can be substantially different. And so when I'm looking to make an investment and put that commitment into, I really want to be locked up for 5 years. And so you need to start thinking it is how it is that your investors think about what it is that you're pitching them and ask and answer, be able to answer those questions before they ask it.
Sure. And that's especially important if you're a small fund because you can't do everything as a small fund. Maybe if you grow to billions of dollars, then you can do
Yeah.
multi asset classes. Maybe you still see, 5, $10 billion funds investing in the same thing that they've been doing for 20 years, which is interesting. Yeah, so Jeremy, where do you see the biggest opportunities right now across the capital stack, across different asset types?
Yeah, I mean, I think the future then in my mind, I think the future right now over the next, 15 to 20 years is going to be in private credit. I think that we are going to this is what it is. We've been doing private credit since before private credit was cool, right? But when we look at this, I see private credit over this next kind of 20 to 25 years having the same bull run that we've seen private equity have over this last 30 years, right? Like private equity has become such a dominant force in the market is that private equity is replacing and taking over the inactivity that has come from SPACs and IPOs and companies going public. It has taken over this kind of dearth and removal of where banks have been active. Like private equity has become the new banks. Venture capital has become the new private equity. Angel investors have become the new venture capital, right? And so there's this movement in how things are. And so I think what it is that we are going to witness combined primarily from a couple things is that private equity has kind of drug private credit into its success. If the banks aren't there, private equity is looking at private credit to fill that void. As private equity continues to raise capital, private equity is always trying to figure out a way to make a $5 bill look like a $20 bill. How can I do that? I can add leverage to it. I can add debt to it. So as private equity continues to grow, they're kind of pulling private credit with it into that success. And so private credit now, combined between the demands of private equity and where banks are kind of leaving off, like it's no longer going to be alternative lending, right? That's what it's been referred to for 15 or 20 years. Oh, they're an alternative lender. It's a non-bank lender. In the next 5 years, it's not going to be alternative lending. It's just going to be lending. And banks are going to have a smaller part of that. So everything it is that we've seen over this last year or two, every headline, 50% of them are direct lending, private credit, asset-based lending, one flavor of this. Because of this massive trend, I think that we are going to see that as probably this next kind of 20-year run is going to be in private credit. That's where I think opportunities are.
Definitely. Yeah. And are there any specific asset types that you're looking at, lending to? You mentioned real estate, you mentioned, private companies. Are there any specific industries in those or asset types in real estate?
You know, for me, I try to stay in my lane, and every day I'm reminded about how much I don't know. There are lenders it is that specialize in everything, right? They'll do just royalties. There's lenders that'll do just music. They'll do licenses. They'll do legal and litigation. They'll do whatever it is. The things it is that I know that I'm good at, that my little second grade brain understands, is I understand kind of small business, companies that are 10 to $100 million that are growing that need differentiated capital. I know how to do that. I know how to structure that. I know how to protect that. The other value it is that I see is I understand kind of the fundamentals of real estate, and how credit and lending and monies work there to structure it and protect it. The parts it is that I'm good at, and again, it's just me, is the single family, multifamily side of things, right? It's construction, development, land entitlement, multifamily development, leasing, and sales. I understand that. Industrial, I understand okay, but I don't understand, data warehouses. I don't understand ports. I don't understand airport. Just never learned. I'm not dumb. I'm just ignorant, right? And so for me, where it is that we see our dollars going into is continuing to exist and loan money and invest in small business and kind of the fabric of America. These companies, 10 to $100 million that need differentiated capital. I am good at that. The opportunities kind of on a go forward basis when it comes to real estate is we still have a deficit to demand on housing, right? We are roughly 5 million units short in the country right now for where it is that we need. We had, I think, 500,000 or so starts last year, which, means we're 4.5 million shy. We take that and we look at basically the functional obsolescence of about 25 or 30 million homes across the country that don't need to be rehabbed. They need to be fucking burned down, right? Like start all over, right? And so housing is never not going to be a demand, because whether you're a plumber or the president or whoever it is that you are, you need a place to sleep, right? I think we see that, and I think that we see this move towards the world that's a renter nation, unfortunately, right? So much of the United States has been built on this kind of ownership, own your own home type thing. We're the only country in the world that does that, by the way, right? You look at families in the UK, you look at families in Asia, and if they're not renting, if they're owning, it's multi-generational. And this is the Walker family household, and your parents own it, and you own it, and your kids are going to live there, and this is the estate. It's not Weston has his house, and your sister has her house, and John has his house, and your parents has it. It doesn't work that way, right? So with the expense and how expensive things are getting in the United States right now, we're moving towards a renter nation. Everybody it is that I know your age is questioning the fact of, shit, dude, I'm in Scottsdale, and the average home for a normal house in Scottsdale is $850,000. I just got out of college. I'm happy to have a job, but I'm making 65, 75, 85 grand. The fuck am I going to buy an $800,000 house? Right? And so you're moving towards that renter nation world. And that's going to have different nuances in it of multifamily or build to rent or otherwise. And so I think for us, our dollars are going to go to corporate credit, small businesses, and our dollars are going to go to where people need to sleep.
Yeah, and like you said, 850,000. I'm in Phoenix and I want to live in Scottsdale after college.
Yeah.
I'm 20 years old and it's going to be, a hike to get able to afford a
Oh,
down
yeah.
payment and the mortgage. And it's not like a rent by choice, it's a rent by force, really, because
Yeah.
it's tough. I mean, you have to make so much money to have that. Yeah, so Jeremy, you have the funds and you have the advisory business as well. Can you talk a little bit about the companies that you advise and, the real estate projects that you advise on as well?
Yeah. I mean, so uh, before we started the fund business, our business was really kind of investment banking and advisory, and did well with that and loved it. Um, our investment banking business is kind of an advisory business is kind of shown back up the last 6 months unconsciously. Haven't been hunting for it, but it's kind of coming to our door. And so I think a part of this is what it is that you may have been reading, or your people listening may have been reading, is this over this last 15 to 18 months, we've been hearing about this basically commercial maturities it is that are coming, right? This maturity cliff. And so 8 to 10 years ago, we had a massive originations it is, and securitizations in this kind of 3 to 3.5% market that 8 to 10 years later, fast forward, is starting today, started December of 23, December 24. So we have roughly 4 trillion, 3.5 or $4 trillion of maturities coming up. It is that guys it is that own massive multifamily, massive office, massive industrial, anything else that bought, built, securitized this, and lent on this 10 years ago are coming from a 3.5% market into a 6.5 or a 7% market. And so imagine your house payment, your car payment, whatever it is. If your interest rate doubled overnight and your car payment went from $500 to $1,000, that's painful. Now put that in a situation with somebody that owns 50 million or 100 million or a billion or $10 billion worth of assets, to where it is that your car payment just doubled. Now, if I couple that with the fact that is that if you're in office, you've still had this mass swath of people it is that are now coming back from a return to office, that prior to COVID and everybody kind of going to work from home, you went from 80-90% occupancies to 30% occupancies, or excuse me, right, 80 to 90%, occupancy to 30% occupancy. That vacancy rate is huge. My interest rate has matured. Cap rates have gone from 4.5 to 6.5. And so we've got clients that had, 100 million in equity, or a billion or two in equity, that through no fault of their own, no change of their portfolio, just basically taking 3.5, moving it to 6.5, taking a 4.5% cap rate, moving it to a 6.5% cap rate, $1 billion in equity has gone, at least on paper. And so a lot of our advisory business now has been holding hands and walking these guys, off the ledge first, and then kind of coaching them through and working with their lenders to figure out a solution on a go forward. That has been the preponderance of that. And so we have right now 4 engagements, 4 clients that are in the kind of $1 to $5 billion mark, that are running through those issues, that just need help walking through those waters. And that's been the majority of where our banking and advisory business has been the last 6 months.
Sure. And where do you see, the best solution for those problems? I mean, a lot of firms are kind of going under in a way, but they can still, run their business going forward, buying assets, but they're having trouble with their current portfolio. I mean, where
Yeah.
do you see the best solution for that?
The reality is there is not a solution unless everybody comes together and agrees to get religion, right? And to get with the reality of what is going on. And so there's 2 clients I can think of now, one of which they're about 2.5 billion in assets, single shareholder, and about 8 or 10 different lenders across their portfolio, right? So they'll have 5 assets here with lender A and 5 assets here with lender B, and that kind of thing, right? Um, our engagement with them so far has been good, because they are well aware of the realities and the vulnerability of where it is that they're at. The positive thing there is that their lenders, people it is that have loaned them money, some of these are are securitized CMBS, and some of these are, Joe the lender, right? A private lender of one kind or another. Those guys have recognized the fact of the extenuating circumstances are causing this issue, and if we don't come together and solve, and if I don't take my loan balance from 250 million to 150 million, then there's a chance it is that I'm going to lose the whole thing. And so uh, we have found the most resonance there to where it is that the operator owner, the lender, and us bringing in new capital tend to recognize the value of each other. And so, Jerry Maguire, this thing, like I need you like you need me, right? Like I depend upon you like you depend upon me. Unless the guys that are doing that, we're getting to solutions. We have another client that owns a massive amount of apartment buildings. They have some assets, it is that, again, through no fault of their own, fully occupied, fully stabilized, cash flowing, doing well, but their car payment just changed. They went from 3.5 to 6.5. We went from a valuation of this portfolio being, a 4.5 to a 4.7 cap rate now to like a 6.5 or a 7 cap rate to get it done. And their common equity is probably dead. If you were forced to sell it today, not only would you not make money, but you probably couldn't satisfy the lender. The owner, developer, asset manager is coming to understand that, all right, we need some help here. Their lenders are refusing to participate. And so not only will the common equity shareholders of the asset manager probably get wiped, that lender is going to take a bath. And because they're not recognizing that, everybody's going to get screwed. And so again, for the people that are listening that went through 2008, the totality of the exposure in 2008 it is to right size those banks, whether we should or we shouldn't have was a totally different discussion. But the total size of that in 2008, so whether you lived through it or you read about it, was about 780 to maybe 800 billion. Okay, which is a gobsmack of money. The commercial maturities it is that are happening right now is almost 4 trillion. This is like 4.5 times the size of 2008.
Yeah, so it's a different type of recession.
It's a quiet one. There is going to be a massive repricing of assets that it will either people will lean into it and get the problem solved, or it's going to be forced upon them whether they want it to or not.
When do you see in the near future, do you think there's a buying opportunity when these assets come available and these loans mature through forced sales? I mean, when do you think that period's going to be?
It's happening now. I mean, there is a large, a north of $100 billion manager it is that we know that is actively buying and purchasing and making unsolicited offers on downtown New York high rises for 50 cents on the dollar, and people are buying and people are selling them. And so
Oh,
it's happening right now. My concern's not the right word, but just something I'm aware of. My frustration here is that the folks ultimately it is that are going to win the biggest here are going to be the top 10, are going to be the State Street and Apollo and Carlisle and BlackRock and Blackstone and these guys, because candidly, they've got all the gold. They got all the money, right? And so when time comes to where you need to make a big decision and take a big opportunity, they got more money than you and me. So I want to look at that approach to what it is that they're taking from an opportunistic standpoint and just right size it into Jeremy's life, right size it into JB Capital, right size it into Weston's life. How can I take that approach at scale to something that makes sense for me? So it doesn't have to be that I'm buying a skyscraper in downtown Phoenix or Dallas or New York, but it could be the fact that is that I'm going to go buy a 10plex at a discount. I'm going to go buy a small business. It is that's upside down. It is that I'm not being predatory. I'm being opportunistic, right? Like when I see Jamie Dimon last year, it is go to cash like $400-500 million. When you see Warren Buffett move out of large, significant positions and go to cash and sit on that kind of thing, they're waiting, right? Because there's going to be blood in the water very soon.
Sure. Yeah, and how can the small to medium sized operators take advantage of the times that we're in?
Yeah. I mean, I think first things are is open your eyes, right? Pay attention. Oftentimes it is there's things happening right around you. It is that you're busy with your normal life and you're candidly just not paying attention. So, like, read, think, ask questions. Why is this happening? Am I seeing a trend? It is that Jamie Dimon moved to cash and Weston moved to cash and Buffett moved to cash and so moved to cash. Why are all these people moving to cash? Right? Like, start just think. The other thing is I'd read. I'd listen to tons of podcasts like yours, Weston. Right? I would start collecting information to get my mind kind of attuned to that frequency of thought for opportunity. That's hugely, hugely, hugely important. And then I would start looking at how to structure deals. I'd understand a little bit about how money works, whether that's an SBA loan, a small loan, or a rich uncle loan from some guy at the golf course, right? Learn how that stuff works. And then you need to move, right? You need to try. Um, this will be one of the things that over this next couple of years, if you are not trying to buy a small business, if you are not investing in real estate, if you are not trying to do something in this move to where it's opportunistic, um, you're going to regret it 10 years from now or sooner.
Absolutely. Yeah, one last question for you, Jeremy. If someone, an operator is looking for you to advise on their fund or, an investor wants to get in touch for your future funds, how can they reach you?
Yeah. So first, thanks for asking. I appreciate it. So it's pretty easy to find us. I mean, you can look at Jeremy B. Hill across LinkedIn or any kind of social channels. I'm pretty easy to find there. Website for us is JB, as in boy, jb-capital.com. There's plenty of places it is to connect with us there. And so whether it's advisory work, fund work, or you want to sit down and have a whiskey and talk good story, we like to do that too. So,
Awesome. Thanks for coming on, Jeremy. Really
buddy,
appreciate
I
it.
enjoyed it. Thanks for having me, Weston.